the ladies. If you haven't met me yet, I'm Cody. This is Madison, and we are actually doing something completely different. We are taking over for Greg and Pablo today, and we decided we're going to have a little bit of fun. So we're actually over at Sweet Pete's here in downtown Jacksonville, and we've ordered some drinks, and we're going to have lunch in a little bit. And we really wanted to give you all an opportunity to get a sneak peek into our Not Your Average Investor Guide and do a little lunch and learn. What do you think? Yeah, we're really excited to have everyone here. It's going to be a lot of fun. Now, I have no ability to do the amazing roll call that Pablo can do. I don't know about you. Well, we really want to make sure that you guys are being as interactive as possible in the chat for us. I know if you are new, you're probably like, who are these girls? But we work with the marketing team here, and Pablo and Greg are normally our hosts, and Pablo typically has amazing little nicknames. What is it? MTM for you?
Yeah.
I'm Mama Bear. So what I would really love is those that have been with us for a long time, I would love for each of you to go ahead and comment in the chat what your nickname typically is that Pablo does the roll call with. And if you're new, if you're tuning in from YouTube, you can always join us over here on Zoom. But if you are here, welcome, welcome, welcome. Please introduce yourself in the chat. Tell us your name, tell us where you're from, and we are just so excited to get started. Yeah, all right. So we're going to start with showcasing a little bit of our Not Your Average Investor Guide. You're going to see here. So if you guys do not have access to this yet, if you have not signed up, we have over 200 students already, which is super exciting. You go to jwbrealestatecapital.com/class, and you can see all of the details there. Now, because we're taking over, we're going to tell you guys now, early on, we decided to make the executive decision that we're going to offer a discount promo code today. So normally this guide is $997, and you figured, why not just do a little special? So surprise to Greg and Pablo, we are offering this entire guide for only $99. Now you can go to jwbrealestatecapital.com/class and use the promo code 99 special when you go to checkout, and you'll get it only for 99 bucks. What do you think about that? I know. Maybe we should. Maybe everybody should just do an in-person JWB show, and we'll do it right here at Sweet Pete's. And so wanted to showcase really how cool the interface is to learn. It's so easy. You're going to, once you sign up, you're going to log in, and you have an opportunity to start right here. And then what we're going to do is go ahead and go to lesson 3. We're actually going to just give you a free preview of what lesson 3 is, and we're going to all learn together the magic wealth sauce.
This is Pablo.
This is Greg.
And right now we're going to talk about what I think is the most exciting part of this investment class, and it is leverage. And specifically what leverage means when you are thinking about an appreciating asset. GC, what is the concept of leverage?
Leverage is like your secret weapon. If you can understand how to use leverage as a tool, you are going to significantly decrease the timeline it takes you to get to your financial goals. And so what leverage really is the ability for you to use other people's money. And you can do this in a safe way, in a risk mitigated way. But when you do this and you invest in an asset that appreciates, you get multiples times that appreciation as your return on investment.
Perfect, man. And for you watching, if you watch the Karate Kid intro that we explain everything, this is that thing that supercharged the investment at the end. And that's why we want to start with it. It's the most exciting piece. So you mentioned a couple of things there, GC, and this idea that it's the secret weapon and all these different things. I think what's important to understand is leverage means that you're going to put a certain amount of money into an investment, and that investment, when it comes to a rental income property, means that you're putting, let's say, $25,000 down to pick up a $100,000 property. and you get returns on the money that you put down, but as it appreciates over time, you also get returns on the rest of the value of the thing, right? That $100,000 total is the return that you're getting. You can't really borrow someone else's money to invest in stocks and get the upside on the stock without using that money.
There's really no leverage in the stock market. And if we go back to the Karate Kid presentation, that's why stocks actually appreciated more on a percentage basis, but our return on investment as Daniel's son, as the Karate Kid, was actually higher in Jacksonville rental properties. And the key to that was leverage. And so, if we think about this, we'll put some dollars to it. You gave the $100,000 example. Let's talk more about what a real property costs, because this will actually show it a little bit more, right? Let's say that a property costs $300,000.
Okay.
Right. And if you're putting down 25% of $300,000, that comes out to $75,000 that you'd be putting down on a rental property. Well, you put that $75,000 down, but if that asset, if the market actually appreciates 4% a year, you multiply that $300,000 times 4%. And that comes out to a $12,000 gain. So that's the real key there. You're putting down $75,000, but when it comes to the appreciation of the asset, you multiply that times the amount of the total value of the asset, that $300,000. And that's why this is so important to understand. That's why it's kind of sneaky too. That's why your friends who invest in the stock market will say, oh, my returns in the stock market are this is better than what appreciation is in real estate. But that's not really what affects your pocketbook.
Yeah. And again, that appreciation rate, if we're talking about a 4% appreciation rate and you're putting down a quarter, it means that you are essentially getting a 16% appreciation rate.
There we go.
Right. And that is why when someone says, well, the market returns 8%, and it sounds really great in comparison to that 4% appreciation rate you get in real estate, if you are leveraging your investment, you are beating the pants out of it.
Exactly.
All right, now let's look at the numbers. We're going to put in the Jacksonville historical average home price appreciation rate of 4.6% and watch what happens.
Well, looky here.
GC, I just saw two numbers go up, one number go way up, and another number go up normally. Tell me what happened there.
Well, this is what happens when you combine leverage with appreciation. Great things start to happen for this asset class. And so what you saw is on the cash purchase, your return on investment, your IRR went up, but on the conventionally financed purchase, it went up significantly more. This is the beauty, like we just talked about in the previous video, where you put a small amount of down on a property, you borrow other people's money for the larger portion, and you get the benefit of appreciation of the entire asset. And what it does is it ultimately takes you to a significantly higher return on investment.
Yeah, and that's what we're talking about. You can't borrow money to buy stocks and only pay for 25% of the price of the stock and then benefit from the depreciation.
Right.
And this is something that happens as time goes on, right, GC?
Yes, absolutely. Home price appreciation happens as time goes on. And the beautiful thing, and I'm sure we'll talk more about this, is that over long periods of time, home price appreciation is something that is normal. It starts to repeat itself. There's a significant trend. And this is why this asset class is something that you can actually count on home price appreciation if you follow a couple of rules, which we'll talk about in another video.
All right, coming up next is when you can't count on home price appreciation. But for now, we want you to be dazzled by the magic of leverage.
Okay, so even when Pablo and Greg aren't even with us, they are with us. They really covered some amazing stuff there with home price appreciation. We're going to have right into the next video, which is when you can't count on home price appreciation, so you don't get fooled. So stay tuned, everyone.
This is Pablo.
This is Greg.
And now we're going to talk about when you can't count on home price appreciation, because you hear about it all the time. You're like, I'm investing in rental properties, but I only got to do it for the cash flow because I lived through the Great Recession out here and I know I can't count on it, right? Sure. So GC, that's got to be right because it happened to some folks. But how do we make sure that we can count on it?
Well, what we need to do is to have some perspective, and data plus perspective helps us make really great decisions. When it comes to home price appreciation, if you look at the data over a full market cycle, which is defined as 10 to 20 years, certain trends start to emerge. And the same historically accurate home price appreciation rate that you've had over the last 40 years, if you go to 10 to 20 year segments of time, you get really darn close to that same amount of home price appreciation. And you can go in the 80s, you can go in the 90s, you can go in 2000s, 2010s. This really plays out. And so the conclusion there is that if you are in the game for a full market cycle between 10 to 20 years, you actually can count on home price appreciation. And the alternative is, if you are a buy today and try to sell tomorrow type of investor, you can't. That's speculating on home price appreciation. But if we relate this to how people make decisions in the stock market, you'll talk to your friend and your friend will say, well, listen, the market always comes back and I'm going to earn 9-10% in the market if I just hold on for the long haul. That's the same thing for home price appreciation. There's really no difference when you look at the data.
Got it. So to simple it down for Mr. Non-real estate expert like myself, unlike this guy, the people that got hurt by home price appreciation were the people that were trying to buy a house and then sell it a year or two later, and counting on the fact that it would go up and not counting on all those other costs to come back to them. Mm-hmm. When that happens in the short run, they got hurt. Folks that buy a home that hold on to it for a long cycle, this idea of like 10, 20, 30 years, then they ride out those smaller blips if they ever happen and end up normalizing to what is the local market's historical rate of appreciation over a long time.
Absolutely. This asset is built about time in the game. The more you have time in the game, the better your return on investment is going to be. And the largest driver of that return on investment is going to be the home price appreciation that comes to you. You just can't count on it overnight. You can't count on it over 1 year, 2 years, 3 years. Things happen. It might be really high. It might not be so high. But over 10 to 20 year segments of time, it's going to return to right about what that was over the last 40 years.
Yeah, you sound just like my financial advisor that was telling me that it's time in market in the stock market, and you can't time the market. You just got to be in it for a long time, right, GC?
Exactly.
All right. So now that you understand that, now that you understand you can count on it, as long as you're planning on holding it between 10 to 20 years, you're safe to use historical averages. What's the next thing that we have to understand in order to really make money with this?
Well, we need to understand that not all real estate markets are created equal when it comes to historically accurate home price appreciation rates. And there is a huge, significant difference in your overall return on investment if you choose a market that does appreciate more versus if you choose a market that does not appreciate more.
So GC, let's compare a couple of markets. I know that you put together this spreadsheet here. Why did you pick these cities in particular?
Well, I chose these cities because these are typically known as your cash flow cities. I didn't choose San Francisco. I didn't choose New York because you're not going to have positive cash flow in those markets. And if you don't have positive cash flow, you're probably not going to be in the game for 10 years or 20 years. And you're probably not going to scale up to 3 properties, 5 properties, 10 properties.
Got it. We cover that in the cash flow section of this class.
Exactly. So these are your markets that if you think like we do and you want to buy a positive cash flow investment, be in the game for a full market cycle so you can profit from all 5 profit centers, you're probably looking at these types of markets out here.
Okay. So here we have price appreciation for the different markets, and then we have population growth and population size. What's important about population growth and population size?
Well, population growth is a key driver of home price appreciation. So you're going to see some significant correlation between those markets that have significant population growth and the ones that have significant home price appreciation. That should make sense to everybody because people need a roof over their head when they move to a certain part of the country.
Sounds like supply and demand, right? If the demand for homes is going up and the supply is relatively stable because homes don't get built overnight, then pricing is going to go up. So we see in this chart of different rates of population growth, and no surprise, it is directly correlated to the higher the population growth is, the higher the price appreciation rate is, with Jacksonville here happening to have the highest price appreciation rate. GC, you also have population size in this chart. Why does population size matter?
Well, size of the population matters because you want to be in a market that has a significant economic presence, that has significant economic drivers. And when there are economic drivers in a market, you can bet that they have a certain amount of kind of critical mass of population. And this is important for you because economic drivers mean that you have residents that are going to be able to pay rent, that there are jobs that support this. And there's more than just maybe one company that is supplying the town with jobs. So simple rule of thumb, when you're considering a market, focus on those that have at least 1 million people out there. That's an easy way for you to kind of cross-reference the ones that you should be considering based on those economic drivers.
All right, so lesson learned here, GC, is that the price appreciation rate per market really, really matters, and it changes. It's driven by population growth as a direct correlation, and you also want to have a minimum population size of 1 million so you can count on those numbers as a stabilized market in order to count on home price appreciation.
100%.
I have a question here, GC, is the fact that, you know, these numbers, they're not like it's not like a huge spread, right? They look pretty similar. Why is such like a small margin important here?
I'm really glad you asked because this is one of the most commonly misunderstood elements that make choosing the right market so important. You see a difference of maybe less than 1%. You're like, what does that really equate to? When you actually run the numbers on an asset that might be a $200,000 or $300,000 asset, 1% of difference of appreciation rate combined with leverage equates to hundreds of thousands of dollars of total return on investment difference over a 20-year hold. So that's like earning hundreds of thousands of dollars more by choosing the right market that historically grows more than another market. And then if you want to take this to the next level, many investors want to scale up. They want to own 3 properties, 5 properties, 10 properties. It literally might be $1 million decision that you make by choosing the right market or leaving that $1 million on the table by choosing the wrong market.
Sounds like a lot of money, man. Let's test this math, shall we? We're back in our deal evaluation sheet, and we're gonna just change it from this Jacksonville number that your sheets come from to, let's say we drop it 1%. So we're going from 4.6% to 3.6%. Explain to me what we just saw, JC.
So your total returns on investment dropped, right? But here's the thing, kind of like what you were just asking. It didn't drop all that much on a percentage basis, a couple of points or whatnot. Does that seem like that's significant to you?
It didn't seem very significant.
This is what most people don't understand. A couple of percentage points, when you're talking about assets that appreciate, that are worth $200,000 or $300,000 when you purchase them and appreciate over 20 years, that is significant. A couple of points of return equate to hundreds of thousands of dollars of additional return on investment simply by choosing the right market.
So if we're going to summarize here, GC, what we learned is that for home price appreciation, for you to be able to bank on home price appreciation, you got to be in it for a full market cycle. People get hurt when they try to buy a house and sell it a couple of years later, and they're counting on that home price appreciation because in the short run, it's more variable. That being said, anybody that gives you financial advice is giving you financial advice based on the long run, right? Like my financial advisor is telling me that in the market, in the stock market, as long as you're in it, you're writing it out forever, then you can count on X, not different than that, right? You just got to be in it for a full market cycle. And then the same assumptions we can make for the stock market, you can make for home prices as well. Okay. So once you understand that, then it's all about the data. You can look at data for individual markets. There is no national home price appreciation that's going to affect your portfolio.
Right.
Each individual market has a number that you can look at and see in the 10 to 20 year average. You can bank on that happening very, very close to that in the next 10 to 20 years, the next full market cycle. And that is largely driven by population growth and by the stability of having at least 1 million inhabitants for you to be able to count it for the next market cycle as well.
Well done.
And then once we figure that piece out, we really want to analyze those numbers, because just a 1% or less can lead to hundreds of thousands of dollars extra per property and millions of dollars if we're talking about a portfolio of rental property investing. How'd I do?
Well done, brother.
All right. Well done. Well done. Okay, guys, I don't know about y'all, but I'd love to hear in the comments, is there anything that was surprising in the numbers that they did, in anything that they discussed? I would love to know what you guys learned from that. I mean, the biggest surprising thing is definitely for me, the market cycle, right? How long the market cycle lasts. And it's not just a short-term thing, it's this long-term thing. And you're really reducing all of the roller coaster that stocks really provide.
Yeah, my biggest surprise was that you bank on home price appreciation on the growth of population. That was something that was really interested in me. I didn't understand that those two went hand in hand, but it makes complete sense that they do.
Yeah. Very cool. Very cool. All right. So just want to give you guys a reminder, if you are not a student of the Not Your Average Investor's Guide yet, this is excellent for somebody that is interested in real estate investing, but not sure where to start. It's great for somebody that is active in real estate investing, but you really kind of want to learn the JWB way and how we kind of make magic and how we build long-term generational wealth for all of our clients. If you really just want to join in and learn some more, this is excellent. We have about 21 different modules. We cover all of the different cash flow, all of the different ways that you can make money with real estate investing. And it's just chock full of stuff. As you could see there, Greg and Pablo did an amazing job putting the course together. So in the chat, we're going to put a link to go ahead and sign up. And like we said, we took charge and we decided to do a $99 special. So the promo code is 99 special. If you want to go ahead and get, $887 off. Can't beat that. All right. Well, this was so much fun, guys. Just wanted to let you know that Greg will be back in action on Tuesday. We're really excited to have him back. And beyond that, what do we always say? All right. Bye, everyone.